Welcome to the B.F. Anderson Technical Report for October 27th. You know, when I started in the business in 1976, I remember how difficult getting people to invest in the stock market was because the market had peaked in 1966 and inflation started to pick up, got a lot of steam going. We also had what we called stagflation, which was where unemployment was going up along with inflation. So Ronald Reagan coined the term the misery index. And so what I have here is the misery of the past present. So what this is where we take the unemployment rate plus the inflation rate, you end up with the overall misery index. You can see here with Jimmy Carter, it was quite a high number. So here we are now, and you can see what the various numbers are. But the thing that's important to realize right now is that unemployment is not an issue. Now, inflation is an issue, but people can get a job. And back in the 70s, I can remember very clearly it was very difficult getting jobs back then. Now, if you can kind of just look at this on a graphical basis and understand it. This is the producer price index. This is a measure of inflation that's primarily used by the Federal Reserve, so I think it's important. So what we have here is a period where, the producer price index went fairly flat in the early 80s, and then in 1988 started to break out, or 87, 88, started to break out to the upside. So just like now, you can see here where the producer price index, since 07, 08, has been pretty much moving sideways and has decisively broken out here recently. So we are seeing inflation. There's no doubt about it. So you can see here where inflation really got going. So what did the stock market do during this period? Well, from 12/31/87, which is beginning around here, till 2000, which is in here, the S&P went up 457%, and this was during a period of pretty active inflation. The Dow went up 473%. The Nasdaq went up 1,402%. So the other correlation that I think is interesting is what were interest rates doing during this time? Well, you can see here measuring where we're using the 10-year Treasury note as our yield. Interest rates were dropping dramatically during this period from 1982 until here, and interest rates continued to go down. Well, they're doing the same thing here. Everyone keeps talking about interest rates going up. The trend is down. There's no doubt about it. So anyway, interesting to look at. Everybody's worried about inflation, but we don't have high unemployment. Big difference. No stagflation. Okay, let's just look at the market for a minute here. This is the Nasdaq. You can see again, we had the correction. We're pulling out of it. Like I said last week, might be a good time to come out of the storm cellar. This was really a good buying opportunity in here, which we did participate in. Now this indicator here, which is the 35-week moving average, clearly is the better indicator that we're looking at. It has been very steady, holding this, this particular moving average during this correction, very positive. Now on the other indexes, so you can see here where the market is starting to broaden out. Here's the mid caps breaking out, actually making new highs. This is the New York Composite, very strong, breaking out. This is mainly financials and industrials. The small cap stocks continue to somewhat languish, not making new highs, continue to be a problem area. The S&P 500, no problem, breaking out, making new highs. Now again, just like the Nasdaq, the S&P has been very favorable and holding that 35-week moving average. This is a very good indicator. Now, the aggression index continues to look better. We did pull back. We tested the 40-week moving average, have been pretty much in an uptrend ever since. So growth stocks continue to look strong. Now, on the three economic indicators, interest rates are kind of stabilizing in here around the 16 the 1.6, 1.7% range for the 10-year note. Oil prices definitely in an uptrend. Now, we're going to talk a little bit about oil later in the video. The oil stocks are definitely showing some promise. Financials, again, as interest rates continue to basically stay in an uptrend, so are the financials. New lows on the New York Stock Exchange starting to stabilize. It's a very positive sign. The inverted yield curve, again, we're not seeing any inversion, but actually a turn up. So that's looking fairly inflationary, but looking positive. Now on sentiment, we're seeing kind of things heating up a little bit. We got a reading of around -18 here on the bull-bear ratio. Now we've moved back to a +18. So sentiment is switching. This was really, as far as a sentiment indicator, this was somewhat of a buy signal. Now on the put-call ratio, we continue to stay in greed. No changes there. On the junk bond ratio, now as I'll remind you, as people worry about default, junk bonds will underperform treasury bonds. But right now they're outperforming treasury bonds, somewhat of a little bit of a pullback. We're continuing to hold that 200-day moving average. So the junk bond market is certainly not collapsing. Now I have replaced the past growth index that we were using, which was the Russell 2000, with the QQQJ. This is a fairly new ETF that's come out that really somewhat reflects growth stocks in I think a very important way. So you can see here we got the correction, and now we're starting to see somewhat of an uptrend. That's a positive sign. Now, on the volatility index, we're seeing things normalizing here. Rate of change to the downside has been somewhat dramatic. For the last 10 days, we've seen about a 20% drop in volatility, which is a positive. Now, I wanted to point out the energy sector because we're seeing some energy stocks in the top 5. Now, what I have here is a 50-month moving average. This is the XLE, which is the Energy Sector Fund. As you can see here, it's been in a pretty long-term downtrend. Energy has been underperforming the market for quite a while. However, here we can see here that recently, if we use the same XLE, which is the energy sector, you can see here somewhat breaking above a trend line. But, again, I have to emphasize this has got some work to do. So we're seeing the early stages of maybe a renaissance in energy stocks, but I think we should just continue to keep an eye on it. Just be aware of the fact that this has been an underperforming group for a very long period of time. Now, here are the top 5. We own this stock. This is called Cloudflare, mainly into cybersecurity. Stock has been in a very powerful uptrend, holding above that 10-day. Look at all this volume in here. This is what we call a volume cluster. All buying volume in here for about 2 or 3 weeks. We're seeing a little bit of a change of character slightly, but it continues to look fine. Now here is Range Resources. This is an oil and gas company, exploration production, breaking out, making new highs, getting good volume. Like I'm saying, this energy group is starting to show some life after a very long period of underperformance. Here's Asana. This is another software company that we do own. It pulled back quite a bit the other day, or yesterday. It, however, did hold the 10-day moving average. However, pulling back on a little bit of high volume. This is a little bit of a change of character, but we'll keep an eye on it. Here's Continental Resources, another oil and gas exploration company, not making new highs, but continues to have a positive pattern. Here is Devon Energy, another energy stock. Now you can see here, it's been basically, consolidating its gains, because what you have to realize about stocks is we'll get a rally like this, which, stocks don't, trees don't grow to the sky. So you end up getting what we call a consolidation. However, a breakout above 42 would be very, very positive here. So that's it. If you have any questions, please let me know. Thank you very much.